Welcome to the Pro Ticker Deep Dive. We are living through, well, an unprecedented investment boom, wouldn't you say? And all the energy, all the focus, it seems solely concentrated on artificial intelligence.
Absolutely. Money's just flooding the space faster than really any tech rollout we've ever seen.
And it promises to transform the global economy, maybe overnight.
Yeah.
So our mission today is really to cut through that intense enthusiasm
Right.
and figure out if this is genuinely the greatest economic revolution in a generation, or if we're maybe just watching an elaborate speculative bubble inflate right before our eyes.
That really is the uncomfortable question, isn't it? Every serious investor is asking that right now. Are we seeing genuine fundamental transformation?
Mhm.
Or are we witnessing, the inflation of a massive valuation bubble? Our sources definitely confirm the tension. AI technology, look, it's genuinely revolutionary, full stop. But when you actually look at how the market is pricing this future,
That's the key.
yeah, that's where you see a serious disconnect. Some parts of the market have entered territory that feels, well, eerily reminiscent of the dot-com peak back in 2000.
Exactly. So for you, listening, navigating the difference between the real lasting innovation and, let's face it, the inevitable speculative excess that will vaporize eventually.
It's critical.
It's absolutely critical right now. We need to know where the money's really moving and what's driving all this conviction.
Okay, so let's start with the bull case then. Because the scale of this adoption, it's just breathtaking. It really gives investors pause before just shouting, bubble?
It truly does. We're seeing this explosive infiltration into society. Just take adoption rates. ChatGPT hits 800 million weekly users by October 2025.
800 million weekly.
Think about that time frame. It's now the fastest adopted consumer application in recorded history.
Yeah.
That kind of scale, that infiltration, means capital has to follow, right?
And the money flow is astronomical. Gartner projects that total AI spending globally will hit $1.5 trillion by the end of 2025.
1.5 trillion.
Trillion. And just the worldwide spending on AI infrastructure alone, that's estimated to top $375 billion this year. So when capital moves at that speed, it fuels this belief that, okay, this is structurally different from previous booms.
And here's my challenge, maybe, to this simple bubble narrative.
Mm-hmm.
Unlike the dot-com era, where so many hyped companies were basically generating zero revenue on vaporware.
Right.
Today's market leaders, the companies soaking up all this capital, they are absurdly profitable.
That's the critical counterpoint. You really can't compare 2024 to 2000 in terms of that foundational strength. Look at NVIDIA net margins north of 54%.
54%.
And the other big players, Microsoft, Google, Apple, Amazon, they all have these fortress balance sheets, deeply diversified revenue streams. These aren't fragile startups.
No.
They're profitable behemoths using AI to enhance existing cash cows.
So you've got Microsoft integrating AI into its, $97 billion annual cloud revenue. Google strengthening its $175 billion search ad business. The bull case isn't just betting on a new product.
No, it's betting that AI will supercharge these already established winners. The whole thesis really hinges on this conviction that future productivity gains will be so enormous.
Transformative.
Exactly.
Yeah.
So enormous, they'll justify today's premium valuations. Proponents argue AI is as fundamental as, say, electricity or the internet. And if that turns out to be true, well, then today's prices might actually look cheap in hindsight.
That is a powerful argument for the bulls, no doubt. However, when we look beneath the surface of that strength, we start seeing some historical red flags waving, and waving fiercely. And they aren't really about the technology itself. They're about market psychology and, frankly, price.
And the first major alarm bell is concentration risk. This current frenzy, it's highly localized. The so-called Magnificent Seven, the largest tech names,
Apple, Microsoft, Google, Amazon, NVIDIA, Tesla, Meta.
they now make up a staggering 37.4% of the S&P 500.
37%, just 7 stocks.
Their combined market cap is over $22 trillion. That level of concentration, it's a systemic risk. Historically, it precedes major market peaks.
It really does. When you have too many eggs in one very, very expensive basket, the fall is always sharper when it comes.
And if we look at that key historical warning metric we use, the one that gauges overall market health, the Shiller PE ratio, the one that smooths earnings over a decade.
Yeah, the CPE ratio. Where is it sitting now?
It has climbed to 40.
40.
40. Just to put that into perspective for you listening, that is the highest level seen since the year 2000.
Right before the dot-com crash.
Exactly. Right before that crash wiped out nearly half the S&P 500.
40. Okay, that is a number that should absolutely command your attention. Historical data shows that sustained valuations up at this level have preceded market declines. Pretty severe ones, ranging from 49% to nearly 90%.
Yeah.
That metric alone suggests the market has kind of swallowed every ounce of enthusiasm available.
And it's not just the public stock market either. We see the same intensity mirrored in venture capital. VC flows are hyper-concentrated.
How concentrated.
In just the first 3 quarters of 2025, AI startups captured almost $193 billion in funding. That's more than half of all global VC investment.
Wow, more than half. Just on AI.
Just AI.
So that kind of hyper-focus, it creates a real opportunity cost elsewhere, doesn't it? Our sources indicate this is actually creating an innovation winter for non-AI sectors.
That's right. Think about health tech, fintech, mobility. They're facing serious funding droughts because all the available capital is chasing this one shiny object.
Which brings us, I think, to the core paradox here.
Yep.
This massive capital deployment seems to be racing way ahead of actual measurable return on investment.
Exactly. Let's talk about the capital expenditure, the CapEx committed to this build-out. It's truly eye-watering.
Give us the numbers.
Okay, the commitment is enormous. Companies are collectively pledging around $380 billion to AI CapEx in 2025 alone.
$380 billion.
Meta, for instance, they're spending over $70 billion. Amazon's projecting $125 billion in CapEx. They're building this massive AI infrastructure for the future. But the big question is, when does the ROI actually arrive?
Yeah, that's the elusive part, isn't it? Because if we look at some recent analyses of enterprise adoption, well, we find a staggering disconnect.
Staggering is the word. Despite tens of billions poured into enterprise AI investments, 95% of organizations report, wait for it, 0 return on investment.
95%.
0 ROI.
0 sustained value at scale for 95% of the early adopters. Now, that is the number that fundamentally undermines the whole capital deployment thesis, justifying current market valuations.
Think about that. If you, listening, had a corporate project with a 95% failure rate in generating sustained value,
that project would be shut down immediately.
Absolutely. Yet the market is pricing these companies as if they're infallible, as if the ROI is guaranteed.
We can use NVIDIA, the dominant infrastructure play here, to illustrate this disconnect perfectly.
Okay, how so?
Well, the company trades at what, a 48.7 times price-to-earnings ratio, and we look at the valuation of the entire enterprise relative to its core cash flow, that's the EBITDA multiple, it sits at a staggering 59.8 times.
59.8. When we talk EBITDA, we're basically looking at the price of the whole business versus the cash it generates before accounting tricks. A 59.8 multiple tells us the market is assuming they never slow down.
Perpetual growth.
It's pricing in perpetual exponential growth for years and years to come.
And based on more, let's say, grounded relative valuation models, the ones that normalize these extreme historical multiples, where does that put fair value?
Well, those models suggest a fair value for that stock sits somewhere around $117.
Okay, and considering recent prices have been near $203.
That implies about a 42% downside. Just to get back to something resembling historical norms, the market isn't just pricing in perfection, it's pricing in something far beyond that.
Wow. And beyond just the valuation metrics, you mentioned there's another potential issue hiding in all that new construction.
Yeah, there's a potential ticking time bomb. The depreciation trap.
Okay, explain that. What does the math look like there?
Analysts have crunched the numbers. Roughly speaking, the $400 billion being spent on AI data centers in 2025, that's expected to generate about $40 billion in annual depreciation.
Okay, standard accounting.
Right. But here's the rub. It's only expected to generate an estimated $15 billion to $20 billion in actual revenue in the near term.
Wait, so $40 billion going out in depreciation, but only $15–20 billion coming in as revenue?
Exactly. That's roughly a 2-to-1 depreciation to revenue ratio that is fundamentally unsustainable over multiple years. If the ROI doesn't surge, and surge dramatically, companies are going to face a cash flow nightmare down the road. Huge asset write-downs become almost inevitable.
Okay, that really sets the stage for our final analysis then. The sort of risk cascade that you, the listener, need to be acutely aware of when navigating this space. First, you mentioned obsolescence risk.
Right. AI chips aren't like building a bridge or something. They become obsolete incredibly quickly. We're talking 3 to 5 years, maybe?
So fast.
If adoption or demand slows down even slightly, the companies that build all these incredibly expensive data centers are going to face massive, accelerated asset write-downs on this giant CapEx push.
Okay, risk number one. Then there's competitive moat erosion.
Yeah. While one company clearly dominates the GPU space right now, competitors like AMD, Intel, even custom chips being developed by the hyperscalers themselves, Google, Amazon, Microsoft, they're all advancing rapidly.
So the dominance might not last forever.
It's unlikely to. Plus, that concentration risk we talked about earlier, it exists not just in the overall market, but within single companies too. For the dominant chipmaker, their two largest customers account for 39% of their revenue.
39% from just 2 customers.
If either one of those customers decides to switch suppliers or successfully develops their own chips, that's a massive hit to revenue overnight.
Huge vulnerability. And we can't forget about basic physical constraints, right?
Absolutely. This infrastructure requires unimaginable amounts of electricity and cooling capacity. Power grid limitations, data center space constraints, these could seriously limit scaling and increase costs unpredictably. It's a risk that a lot of market models, assuming limitless digital growth, tend to overlook.
Okay, so let's try to bring it all together then. What does this all mean when we marry the facts, the genuinely transformative potential of the technology, with these really alarming valuations and structural risks?
The final conclusion, if we frame it using something like the Gartner hype cycle model, is that yes, the AI bubble is real, but, and this is key, AI itself is also genuinely transformative.
So both things can be true.
Both are true. The key challenge for every investor is simply timing. Where are we on that cycle? We are almost certainly sitting right at the peak of inflated expectations.
Okay, and what typically follows the peak in that model?
Historically, the trough of disillusionment. And we are probably, ballpark, 12 to 24 months away from hitting that point.
And that's triggered when?
That's usually when the collective market finally realizes that, hey, maybe 95% of these early enterprise AI efforts aren't generating cash flow yet. And that realization forces a drastic repricing of the entire sector.
Right. So for your actionable takeaway from all this, the message seems clear. AI is definitely here to stay. It is transformative. But the timing of the actual returns and figuring out the specific long-term winners, that remains highly uncertain.
Very uncertain.
And the concentration risk in those top 7 stocks is dangerous because at these sky-high valuation levels, you aren't just betting on earnings growth anymore. You're betting on continued valuation expansion, meaning even higher multiples from here.
Which is a very risky bet.
And history suggests that's a bet that rarely ends well.
So when bubbles deflate, they don't tend to go gently. They usually fall fast and hard. The real question for you, the listener, to consider is this. Do you truly have the conviction, and maybe the patience, to hold through the inevitable, potentially severe repricing that a correction requires? Or perhaps is taking some chips off the table the prudent move right now while the market is still celebrating? Some food for thought.
See you all in the next Pro Ticker Deep Dive.